Welcome back, everyone. In this lesson, we're going to talk about the essentials of trading, the key concepts every trader must understand before entering the market. We'll explore what it means to go long and short, how leverage and margin work, and why managing your trades with take profit, stop loss, and liquidation control is so important. These are the building blocks of professional trading. Once you understand how they work together, you'll be able to trade with more confidence and control. What does long mean? Let's start with the term go long. When you go long, you are buying first and selling later because you expect the price to rise. If the price goes up, you make a profit. If the price goes down, you take a loss. It's just like buying something at a lower price and selling it later when its value increases. Long positions exist in both spot and futures trading. But in futures, you don't need to own the actual asset. You're only predicting its price direction. Now, the opposite of going long is going short. When you go short, you sell first and buy back later. This means you expect the price to fall and you profit as the price goes down. Here's an easy way to remember it. Going short is basically betting against the price. However, you should note that short trading is only available in futures or margin trading because in these markets, you can borrow the asset to sell it first, then buy it back later at a lower price. In summary, if you predict the price will go up, you have to go long. On the other hand, if you predict the price will go down, you go short. All right, let's look at a simple example of going long in the spot market. Say one altcoin is priced at 1 USDT per unit. You expect the price to rise, so you decide to go long in the spot market. You buy 100 units of this altcoin, which costs 100 times 1 USDT equals 100 USDT. After 1 hour, the price increases to 2.5 USDT per unit. You decide to sell all your coins at this price. Your profit per unit is 2.5 USDT minus 1 USDT equals 1.5 USDT. So your total profit is 1.5 USDT times 100 units equals 150 USDT. That means you spent 100 USDT to open the trade and earned 150 USDT in profit. Now, let's analyze your trade deeply with return on investment. That's also called ROI, one of the most important ideas in trading. In this example, you invested 100 USDT to buy the altcoin and earned 150 USDT profit when you sold it. To calculate your ROI, or return on investment, you divide your profit by your original investment. The formula looks like this. ROI equals profit divided by investment. So that's 150 divided by 100, which equals 1.5. Next, we convert that into a percentage. 1.5 times 100% equals 150%. So your ROI is 150%. That means for every 1 USDT you invested, you gained an additional 1.5 USDT in profit, a total 150% return on your original investment. This is the reward side of trading, but always remember, higher potential rewards usually come with higher risk. We will talk about the risk very shortly. You may think that, how can we increase our ROI, our return on investment? In our earlier example, we invested 100 USDT and made a profit of 150 USDT. But here's an interesting question. Can we earn the same profit without putting in the full 100 USDT? What if we only used 50 USDT or even less and still made that same 150 USDT gain? Is that possible? How about if we only used 10 USDT and still earn 150 USDT? The answer is yes in the future market, and that's where leverage comes into play. Leverage allows you to control a larger position using a smaller amount of your own money. In simple terms, you borrow funds from the exchange to multiply your buying power. This means you can open a bigger trade, earn the same profit, but risk less of your own capital up front. Of course, while leverage can boost your ROI, it also increases your risk because if the market moves against you, your losses are multiplied too. So, leverage can be a powerful tool, but it must be used carefully with good risk management. What is leverage? Now let's talk about leverage, one of the most powerful tools in trading, but also one of the riskiest. Leverage allows you to control a larger position with a smaller amount of your own money. In other words, you're borrowing funds from the exchange to increase your trading power. It's usually expressed as a multiple, like 5 times, 10 times, or even 20 times leverage. For example, if you have 100 USDT and you use 10 times leverage, you can open a position worth 1,000 USDT. In simple terms, leverage multiply your purchasing power. You can long or short more than own capital can do, and you do not need to pay any interest. That means your profits can grow 10 times faster, but your losses can also grow 10 times faster too. Different exchanges offer different leverage limits for different coins. For example, large and stable coins like Bitcoin or Ethereum might allow up to 100 times leverage, while smaller, more volatile altcoins usually have a lower limit, like 10 times or 20 times. So remember, leverage is a double-edged sword. It can amplify your gains, but if the market moves against you, it can also wipe out your account very quickly. Use it wisely and always combine it with strong risk management. Let's look at how leverage can dramatically change your ROI, your return on investment. Example 1, without leverage spot market. Imagine an altcoin priced at 1 USDT per unit. You invest 100 USDT and buy 100 units. Later, the price rises to 2.5 USDT per unit. Your profit is 2.5 minus 1 times 100 equals 150 USDT. So your ROI is 150 divided by 100 equals 150%. That's your standard return when you're trading without leverage. Example 2, with 2 times leverage. Now, let's use leverage. You only invest 50 USDT of your own money and borrow another 50 USDT from the exchange. That gives you 100 USDT in total trading power, the same as before. The price moves exactly the same way, so your profit is still 150 USDT. But this time, your investment was only 50 USDT. Your ROI becomes 150 divided by 50 equals 300%. You've doubled your return on investment simply by using leverage. Example 3, with 10 times leverage. Now imagine you only invest 10 USDT of your own money and borrow 90 USDT from the exchange. You still control a 100 USDT position. The same price movement gives you a profit of 150 USDT. Your ROI now is 150 divided by 10 equals 500%. That's a 15 times return on your own capital. This shows how leverage can massively boost your potential returns, but remember, it can also amplify your losses just as quickly. Let's take a real case. Say Exchange A offers up to 500 times leverage on Bitcoin. That means you could control one whole Bitcoin worth around 110,000 USDT with just 220 USDT of your own money as margin. In the spot market, you normally need to pay the full 110,000 USDT to buy one Bitcoin. Now, if you go long on one Bitcoin and the price rises by 1,000 USDT, you would earn around 780 USDT, which is about 3.5 times your initial margin. But here's the risk. If Bitcoin falls by just 220 USDT, from 110,000 to 109,780, your position would be liquidated, meaning you'd lose your entire margin. So leverage magnifies both profits and losses. Always use it carefully. with strict risk control and proper stop-loss protection. Next, let's understand margin, which is directly related to leverage. Margin is the amount of your own money that you use as a security deposit when opening a leveraged trade. It protects the exchange if your trade moves in the wrong direction. If your balance drops below the required margin, the exchange will liquidate your position to prevent further losses. In short, margin is your safety cushion. The higher the leverage you choose, the smaller that cushion becomes, which increases your risk of liquidation. In any crypto exchange, when you place an order, you can select both the level of leverage and the order quantity you want to trade. The exchange will automatically calculate how much margin or your own capital is required for that trade. Here's something useful you can try. Pause this video for a moment and experiment with the leverage slider. Let's go to any of crypto exchange if you can. Start with a small leverage, like 2 times or 5 times, and increase it to a higher level, like 50 times or 100 times. Watch carefully as the leverage increases, the required margin becomes smaller. That's because you're borrowing more from the exchange and putting in less of your own money. Now, keep the leverage level the same and change the quantity of your order. Increase it from, say, 1 unit to 10 units or even 100 units. You'll notice the margin required increases proportionally with your order size. This exercise helps you visualize how leverage and quantity directly affect the margin requirement. Understanding this relationship is crucial. Before opening any leverage position, it helps you manage your capital wisely and avoid unexpected liquidations. Let's look at this table. It shows how leverage, margin, and quantity are related when you place a trade. In example 1, there's no leverage, or 1 times leverage. You want to open a 100 USDT position, so you have to pay the full amount yourself, 100 USDT margin. In example 2, you use 2 times leverage. You still open a 100 USDT position, but now you only need 50 USDT of your own money. The exchange covers the other half. In example 3, with 5 times leverage, the margin required drops again. Now you only need 20 USDT to control the same 100 USDT position. And with 10 times leverage, you only need 10 USDT. That's just 10% of the total position value. You can see that the higher the leverage, the smaller your margin becomes. Now, look at example 5. We keep the leverage at 10 times, but double the quantity from 100 to 200 USDT. The margin also doubles from 10 USDT to 20 USDT. So increasing quantity increases the required margin, even if the leverage stays the same. Finally, example 6 shows 20 times leverage on a 200 USDT position. Because the leverage is doubled, the margin is cut in half again. You only need 10 USDT. When leverage increases, the margin required decreases. You're using more borrowed funds and less of your own money. But when you increase your quantity, the margin required increases because you're trading a larger position. The simple formula is margin equals total position divided by leverage. This is a core concept in futures trading. Knowing how margin and leverage work together helps you plan your position size safely and avoid liquidation risks. What is liquidation? Now, what happens if the market moves against you too far? That's when liquidation comes in. Liquidation means the exchange automatically closes your trade when your losses exceed your margin. It's a built-in safety system to prevent you from losing more than what you've put in. Once liquidation happens, your position is closed and your margin is gone. The main causes of liquidation are using too much leverage and not setting a stop loss. You can reduce liquidation risk by adding margin or by setting proper risk controls before you open a trade. When you're placing an order in a crypto exchange, you'll notice something called the estimated liquidation price displayed on the screen. This number is extremely important. It tells you the exact price level where your position will be automatically closed by the exchange. Here's what it means. If the market price moves against you and reaches that liquidation price, the exchange will forcefully close your trade to prevent further losses. At that point, you will lose all of your margin, the amount of money you used to open that position. The liquidation price depends on two things: your leverage level and the direction of your trade. The higher your leverage, the closer your liquidation price will be to your entry price. That's why higher leverage means higher risk. Even a small price movement can liquidate your entire position. So whenever you place an order, always check the liquidation price before confirming. It's a warning sign showing how far the market can move before your position is wiped out. Now that we understand what liquidation is, let's talk about how to prevent it. Liquidation happens when the market moves too far against your position and your margin is no longer enough to cover the losses. But the good news is you can take several steps to reduce the risk and protect your capital. Step 1, use lower leverage. The higher the leverage, the closer your liquidation price will be. By keeping your leverage small, like 2 times or 3 times instead of 10 times or 50 times, you give yourself more breathing room before the market hits your liquidation point. Step 2, add more margin. You can always add extra margin to your position. This increases your safety buffer, lowers your liquidation price, and helps your trade survive short-term price fluctuations. Step 3, always set a stop loss. A stop loss order automatically closes your position before liquidation happens. You can set it at a price where you're comfortable taking a small, controlled loss instead of losing your entire margin. Step 4, monitor your position. Don't just open a trade and walk away. Keep an eye on your position, especially in volatile markets. If the trend changes or the market moves too quickly, adjust your stop loss or margin as needed. To sum up, you can prevent liquidation by using lower leverage, adding margin, setting stop loss orders, and staying alert. These habits will help you trade safely, protect your funds, and stay in control, even in a fast-moving market. Finally, let's look at 2 key tools that every smart trader uses: take profit and stop loss. A take profit, or TP, is an automatic order that closes your trade when the price hits your profit target. A stop loss, or SL, is an automatic order that closes your trade when the price hits your loss limit. These tools help you secure profits and control risks, even when you're not actively watching the charts. Smart traders always set their TP and SL right when they open a trade. That way, they don't have to rely on emotion or luck. The system protects them automatically. Let's quickly recap what we've learned in this session. Going long means you profit when the price goes up. Going short means you profit when the price goes down. Leverage helps you trade with more capital, but comes with greater risk. Your margin is the money you put up to open and secure a position. Liquidation happens when your losses exceed that margin. And finally, take profit and stop loss are your automatic protection tools. Use them every time you trade. Mastering these essentials is what separates beginners from disciplined, strategic traders. In our next lesson, we'll look deeper into how profits are calculated and how to build a proper trading plan with these tools in action.